Want to learn more about ETFs, how they work, and what they are? Hi, I'm Jared with Carlin Financial Group. For the best retirement information and to help make sure you don't outlive your money, be sure to subscribe to our channel and hit the bell so you'll be notified when we post new videos. Exchange-traded funds, or ETFs as they're known for short, were first offered domestically in the 1990s and have since become increasingly popular as investment vehicles. Not unlike mutual funds, which you can learn more about in another of our recent videos, they offer investors a way to pool their money into a basket made up of different investments, which could include stocks, bonds, or other assets. In return, the investor receives an interest or a stake in the underlying investment pool or basket of investments, while only having to purchase the one ETF. This could allow some participation in the wider market without costing you, the investor, a great deal of additional research and analysis time. Unlike a mutual fund, and as its name implies, ETFs are exchange-traded investment products, meaning that they trade on a national stock exchange at varying market price throughout the trading day. They're bought and sold like stocks and can usually incur commissions and other related fees. Initially, ETFs were only designed to track the performance of certain U.S. equity indexes, such as the S&P 500. While those index-based ETFs continue to be the predominant type offered and sold in the U.S., newer ETFs can seek to track different types of assets like fixed income instruments, corporate bonds, commodities, currencies, or even foreign securities. There are also ETFs with different investment objectives. Some may track the performance of a particular market sector, like technology or pharmaceuticals, for example. While ETFs generally provide investors with some diversification, which can help balance risk, some more focused ETFs, like one that may track a specific sector, will tend to provide less diversification than an ETF that tracks a broader index might. Certain ETFs can be relatively easy to understand. Others may be more complex and difficult to understand. Leveraged ETFs, for example, seek to achieve performance equal to some multiple of an index after fees and expenses. So the leveraged ETF could aim for, let's say, a threefold return on the underlying index on a daily basis, which could potentially lead to a fair amount of volatility and make this type of ETF unsuitable for some long-term investors. What other types of investments would you like to learn more about? Leave us a comment down below and let us know. So, how can you make money from an ETF? Well, similar to stocks, there are really two ways: a rising ETF market price and dividends. Typically, if the value of the ETF's basket of investments increases, so does the market price. Let's say you purchase an ETF for $30 and a year later the same ETF is trading at $40. In that case, you could profit $10 per share if you were to sell your position. Of course, the inverse is also true. If the market price were to decrease over the year to, say, $20 and you were to sell it at this lower price, you'd experience a $10 loss per share. Because ETFs are traded on a stock exchange, they can be bought and sold throughout the day. However, it's important to note that not all ETFs are widely traded, which can cause difficulty when trying to fill some buy or sell orders. Aside from a change in price, investors could earn income if their ETF pays a dividend, which is a payout of part of the fund's earnings or capital gains. Not all funds will pay a dividend, however, and many will choose instead to reinvest any earnings into the fund's holdings. One way to determine if the fund pays a dividend is to look for the fund's dividend yield, which is the amount the fund pays out compared to the current market price of that share. So, what are some other potential reasons to consider an ETF investment outside of what we've already discussed? Well, one could be the low barrier to entry. Unlike mutual funds, which normally have minimums that could be somewhat substantial, with ETFs you have the ability to purchase a single share. Also, because most ETFs aren't actively managed, they typically have lower management fees, transaction cost, and operating expense ratios than corresponding mutual funds. I will note that is not always the case, however, as there are some ETFs that are actively managed, and you should always be aware of the management and fee structure before making your purchase. These actively managed ETFs are typically not based on an index and as a result may buy or sell portfolio components on a daily basis without worrying about having to conform to an index. Because of the potential for frequent change, these actively managed ETFs must publish their holdings daily. ETFs can also be more tax efficient than mutual funds And as a result, the right ETF could be a good option for tax-conscious investors. As with any investment, it's important that you do not invest in something you don't understand. Before purchasing a particular ETF, you can learn more about it by reviewing its summary prospectus and full prospectus. These are documents that provide detailed information on the particular ETF's investment objectives, strategies, risks, cost, and any historical performance if applicable. I hope you found this information helpful and you've developed a better understanding of exchange-traded funds. If you did, please share this video with a friend and give it a like. If you'd like our help navigating the selection of appropriate investments for your unique situation, you can learn more about working with us and apply to become a client using the link down below. Thank you for joining me today, and don't forget to subscribe to our channel and ring the bell so you won't miss any future tips. And as always, live today, plan for tomorrow.